Hey everyone, and thanks for jumping back into the Macroverse. Today, we're going to talk about the most recent inflation report, and we're also going to discuss implications for assets like Bitcoin. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. Let's go ahead and jump in. So we did just get the most recent CPI report, so we're just going to run through it fairly quickly. The headline inflation number came in at 2.73%. Obviously, the Fed's target is 2%, but 2.7% is relatively close. The only thing to really look at is that it has been going up the last couple of months. That doesn't necessarily um, mean that it's going to reaccelerate to a second wave like what we saw back over here in the 1970s, but it is at least something to keep an eye on. Remember, inflation has essentially been dropping since 2022, right? Since mid 2022. Now, that doesn't mean that prices have dropped. It just means that the prices of items that you buy every day just haven't been going up as much, right? So there's often sort of a misconception about this. Just because inflation is dropping does not mean prices are. The only way you get prices to drop is if you see inflation go below zero, okay? And that would be a sort of a deflationary environment. Now, remember, deflationary environments are sort of what you saw back during the financial crisis, right? So, obviously seeing lower prices is somewhat welcome, but it probably wouldn't be that great for financial markets. So in the short term, inflation has started to tick back up a little bit, right? From 2.4 to 2.6, now to 2.7. Still relatively low, right? Still relatively low. And historically, you can see that the S&P 500 often will find lows around the time that inflation tops, right? And you can see that this cycle has basically been no different, right? You'll see the S&P often finds lows whenever inflation tops. Um, Now the question is will you see sort of inflation reaccelerate? And we're going to break down some of the different categories. But one of the things that we've looked at before, of course, is the 1970s, right? And the reason we looked a little bit at the 1970s is because back then we sort of had waves of inflation, right? Where the first wave topped out in January of 1970, and then the next wave didn't top until about almost 5 years later, right? I mean, it was basically almost January 1975. And then there was another wave of inflation that came 5 years after that, right? April of 1980. So it's always important to sort of recognize what happened in the past so that hopefully we can avoid that this time. I don't really think Powell wants to see that happen again. And so I imagine they're going to try to do what they can to make sure that this peak here plays out differently than what we saw back over here in the 1970s. All right. There are examples before where inflation does spike, not necessarily to what we saw over here, where then it just kind of slowly comes back down. And that's ultimately what we would like to see. I don't think anyone wants to see a second wave of inflation. In the short term, Bitcoin has moved up today. And it makes sense. I mean, Bitcoin's back above 100K. It makes sense, first of all, because, you know, when inflation did start to move back up, even in the 1970s, right? Even when it started to move back up, the S&P 500 continued to go higher. The S&P 500 only really started to sell off again once inflation really started to accelerate, right? Where 1 month it went from 3.8 to 4.8, right? In a single month. Okay? And that didn't even happen back then until the post-election year, right? That occurred out in March of 1973. So that would still be, several months from now if the cyclical behavior does repeat from the 1970s. But you can see that as long as it was sort of these slow moves back up, the market wasn't really that concerned by it, right? It wasn't, this was not, an obvious reacceleration of inflation. The reacceleration didn't actually occur until the post election year. And that's obviously when markets got somewhat spooked by that because, well, markets had just experienced what that was like back over here. And once they sniffed it out again, then they basically were sort of warning, all right, well, the Fed's going to have to raise rates again, and we're going to have to go through this whole process once again. Again, I'm hoping we avoid that outcome. Um, One good thing this cycle so far compared to what happened in 1970s, although there's a caveat. In the 1970s, you can see that inflation sort of bottomed out at around 3% in the summer. Whereas this time, it looked like it was also potentially bottoming out at 3%, but then it actually eventually fell all the way back down to 2.4% by September. Now, the caveat, of course, is that the way they calculate inflation today is different than what they calculated in the 1970s. And in fact, if you do some sort of like back of the envelope math on how they calculated inflation back over here in the 1970s, this peak that we had in 2022 would actually be fairly in line with these peaks we saw in 1974 and 1980. But because they changed the way they calculate inflation, it looks like it is lower. And I've always had kind of a problem with that, not because I don't think it's worthwhile to sort of come up with better ways to measure inflation if they can find them. But, if you're an academic and you have like sort of a data series, and then halfway through you decide to change the methodology for how you're calculating the data point, but you continue to sort of showcase it on the same graph with the other data points, that is, that wouldn't fly in academic journals, right? That wouldn't fly at all. But this is essentially what the Fed uses. They look at this stuff, and even though it's calculated differently, it is all put on the same chart. So there is a caveat to these peaks. It might look like it's not as bad as the 1970s, but if calculated the same way, this peak we had in 2022 was essentially just as bad as 1974 and 1980. It was somewhere up there. I think it was around those levels, definitely in the double digits had it been calculated the exact same way. So I suppose the thing to watch for over the next few months is just, does inflation continue to slowly go back up like it did in the 70s and then accelerate next year? Or does it just continue to go down? If you take a moving average, right, let's take a 3-month moving average, you can see that it is still mostly decreasing. It did go up a little bit this last month when looking at the 3-month moving average. But back over here, right, the 3-month estimate of inflation bottomed in August. This cycle, the 3-month estimate, if this is a local bottom, was not until October. So, if inflation were to reaccelerate next year, perhaps perhaps the big move up is delayed by a couple months. So rather than March, maybe it'll be out in May or something. But that's at least one way to look at inflation. Obviously, one of the things we could do is look at it per category. So I kind of figure out like where is the recent move up coming from. Well, first of all, we'll look at it like this. So this is just per category. Remember, these categories are not all weighted the same. We can look at that next. This is headline inflation. It has been moving up the last couple of months, but you can see, even over here in early 2024, there are some months where it moved up, but eventually it fell. So you look at food and beverage, that actually went up this past month, but food and beverage is essentially at 2%, right? It's been at 2% for a lot of 2024. So, it rose slightly from 2.11% to 2.33%. That doesn't really seem that concerning right now that it had that rise. Housing inflation continued to drop from 4.18 back to 4.13, still a little bit higher than where it was back in September at 4.08, but hopefully still will continue to move down. It does tend to lag most other inflation measures, right? So if you look at food and beverage, normally food and beverage, you can see will sort of top out before housing inflation. You can see that's what happened in the mid 1970s. It's also what happened in 1979 going into 1980. And it's also happened. It was what happened over here, right? Food and beverage inflation topped out before housing inflation, but also, it took longer for housing inflation to fall back down to some of those lower levels. So do keep that in mind. If you look at apparel inflation, it actually went up slightly to 1.13%, but obviously, there's nothing wrong with it being 1%. Transportation went up slightly, I believe. This is one of the reasons why there is a change in headline inflation, is because last month transportation was deflationary, right? It was negative 0.279%. This month it was 0.405%. So it's back to being inflationary. So that was, sort of a headwind for inflation last month, and now it's sort of a tailwind, which kind of partially explains why inflation continued to go up. If you look at medical care, inflation actually dropped from 3.29 to 3.08. If you look at recreation, it also went up from 1 to 1.48. But again, it's still around, it's even below 2%. Education and communication dropped from 0.775 to 0.709. And then finally, other goods and services rose from 3.29 to 3.42. But remember, these categories are not all weighted the same. If you were to look at inflation year over year contributions per category, let's go to the entire series, and if we just simply look at this is headline. So this is headline inflation right here. Now let's go through each category. You can see that food and beverage contributed, right, 3.3 of the 2.7, right? So it contributed 0.3 of the 2.7. That's an increase from last month of only contributing 0.3, right? This one, it was 0.33. If you look at housing, its contribution dropped from 1.86 to 1.84, but you'll notice that a majority of inflation is just the housing, right? I mean, headline inflation is 2.73%, 1.84 of that, 1.84 of the 2.73 is just housing. If you look at apparel, it contributed a negligible amount, right? 0.029, not really contributing a lot. Transportation contributed 0.0679. Again, really small contributions. Medical care contributed 0.246. So, something there. Recreation contributed, rose from contributing 0.054 to 0.08. So that increased. Education and communication dropped from 0.04 dropped from 0.044 to 0.041, and then other goods and services rose from 0.088 to 0.091. So, I mean, all in all, inflation is still sort of loosely at the Fed's target, not exactly at 2%. It's obviously a little concerning that inflation is starting to go back up, especially when you look at it through the lens of what happened in the 1970s, and you can see it kind of slowly started to move up. And then at some point in the post-election year, it really shot up again. This is a scenario I imagine all of us would like to avoid. So I'm going to hope that that doesn't happen, but we will continue to talk about this just in case it trends in that direction. What I'd like to see next month is I'd like to see it continue to come down. And there's chances that it does. I mean, especially considering that housing inflation makes up such a huge contribution, and to note that it still has been in a downtrend, right? If you just take a 3-month moving average of housing inflation, it's basic, the contribution per category, it's just been dropping, right? Very slowly, but it is at least dropping. Now, if you were to look at the monthly change, that's where it might get somewhat concerning because, the contribution from housing, the drop it used to be quite substantial. Recently, it's been getting a lot less substantial. So that was a prior headwind for inflation that could become a tailwind if housing inflation starts to go back up. Now, core inflation is arguably more important to track than headline inflation. And there's also core PCE as well. Core inflation has been a lot stickier. And I think this is, one of the more concerning sides of inflation. Headline inflation has at least dropped below 3%, but core inflation has not, right? And it's been at 3% for a while now. Furthermore, core inflation has been going up since July of 2024, right? It's been going up since July of 2024. It bottomed out in July. If you look at the 1970s, you can see that core inflation basically bottomed out in the summer, right? June, July, but it did go lower one last time in January, which interestingly marked the top for the S&P 500. But the problem is that just like today, core inflation essentially was flat at around 3.2 to 3.3%. And if you go look at the 1970s, that's also where it kind of bottomed out at. And then it wasn't until the post-election year where inflation started to go up once again, and obviously the S&P 500 did not like that. So, market conditions today are obviously different back then, in some ways. One of the things that you have to consider about the 1970s that is somewhat different than today, and we could go look at this on say the S&P 500 chart. If you go look at the 1970s, um, one of the things to consider is if you were to overlay the unemployment rate back then to today, it certainly was a little bit different, right? Like in 1970, when inflation started to really go back up, causing the stock market to top out in January of 1973, it was during a period where the unemployment rate was going down, right? So you were seeing sort of these wage inflation pressures. But you're not seeing that today in the same way. There has been wage inflation, but unemployment has actually been going up, suggesting that things are loosening up in the labor market, which should be a good thing, to help bring inflation down. So that's something to consider here, is that, like, back then when inflation really started to, and you can even overlay it, right? If you look at inflation rate year over year and you overlay it with the S&P, this purple line, inflation started to go back up while the unemployment rate was going down. You see that? Inflation up, unemployment down. But this cycle, it's a little different, right? It's a little different because this cycle, you're not seeing that, right? You're seeing inflation has been going down still, but unemployment is going up. So to me, it's not even necessarily clear that it will play out like it did in the 1970s, because back then, when inflation really started to accelerate, it was during a time when the unemployment rate was going down. But we've seen the opposite of that, right? We've seen inflation go down while the unemployment rate goes up. So, obviously there's always going to be something to worry about, and that's why they call it climbing the wall of worry. And that's why I've said many times that the best strategy for things like the S&P 500 is to not try to time the market and to just DCA, low expense ratio index funds. And obviously that has worked out over the long haul, especially as the S&P continues to push new all-time highs. But just shows you, it really goes to show you that not everything is always as it seems when you look at these prior comparisons, and you have to figure out, like, why was inflation going up back then. And one of the reasons was, because the unemployment rate was dropping, and that was, contributing to a tight labor market, which contributed to wage inflation, which then helped inflation generally go up. Today, you're seeing almost the opposite. Yes, it's true that inflation has started to go up a little bit, and it might become something that the market worries about in 2025. But why not let tomorrow worry about that if it in fact plays out? So far, we've seen inflation drop as the unemployment rate goes up. So in the short term, what the market might be more worried about in early 2025 might be this. If this starts to go back down in 2025 and you start to see inflation go back up, then the market might care about that. But in the short term, the unemployment, the labor market has had a more concerning trend because it's been steadily going up for a while, whereas inflation has only really started to go back up the last couple of months. So going back over to core inflation, ideally we would see it come back down to 2%, but we just haven't seen that yet. It's been hanging out at around 3%. Now, you might assume that because inflation came in, higher for a couple months in a row, and that core inflation is higher for a few months in a row, you might assume that the Fed will not cut rates, but you would probably be wrong, because it looks like, according to the markets, and usually, only a week out, the markets have it fairly correct. I think more often than not. You could argue that the markets tell the Fed what to do, not the other way around. Like, the Fed doesn't tell the market what to do. The market tells the Fed what to do, and the market's telling the Fed that they're going to cut 25 basis points. Um, if you look at probabilities sort of going out, it seems like one potential outcome is, the Fed cuts 25 basis points in December, and then the market thinks they're not going to cut in January, and then they might cut again by March, and then again by June. We'll see. We'll see if that's how it plays out. But in the short term, the market is not really that overly concerned with with the rising inflation. It seems to be a little bit more concerned with the labor market, and I think that's kind of the disconnect here is that it's easy to look at a chart like this and to sort of scream like, why is the Fed cutting, right? Or why is the Fed cutting when inflation's starting to go back up? Why is the Fed cutting when core inflation is not going to their target, right? It's still flat at 3% and their target is 2%. So why are they cutting? Of course, the reason is the unemployment rate, right? I think. I mean, that's what I would assume is the reason is this. That's the reason why they're cutting is that the unemployment rate has continued to go up. If you take like a 3-month moving average of the unemployment rate, you can see that it has been steadily going up. And I think they're trying to sort of keep this from going parabolic. The reason why the market hasn't been that concerned about unemployment is because it's been sort of a slow move up, whereas these prior recessions were more parabolic moves up by the unemployment rate. So I think that's the reason why the Fed continues to cut, because they'd like to slow down the loosening of the labor market before it's too late. And I don't really think you can necessarily fault them for that. And I've said for a long time, they're really in an unfortunate position because no matter what they do, unless they thread the needle perfectly, they will be blamed. If they cut too soon, obviously they'll be blamed, for cutting too soon. If inflation reaccelerates, if they don't cut aggressively enough, and then you start to get a scary unemployment rate print sometime next year, then they'll be blamed for not cutting enough, even though right now everyone's blaming them for cutting too much. So again, I don't envy the position of the Fed. It seems like a fairly difficult position to be in, and I do think they're probably trying to do the best they can to sort of thread that needle. But right now, the market is essentially saying that there's about a 95% chance of a rate cut in December. And actually, it's really mimicking sort of the rate cutting cycle from 2019, almost exactly. Actually, if you think about it, I mean, because in 2019, they did basically the same thing. The only difference between 2024 cuts and 2019 cuts is that in 2019, I don't believe they ever cut 50 basis points, right? It was always 25 basis points, right? You had a 25 basis point rate cut in July. It was like the last day of July. Then you had a 25 basis point rate cut in September, and then I think you had another one a month after that. So you essentially had one and then two, back to back, right? So it was basically three back to back cuts at meetings, but I guess they didn't have a meeting in August, right? They had a meeting in July, they had a meeting in September, and potentially another one, a month after that. So this cycle, in terms of rate cuts, looks similar, but the main difference is that the first rate cut this time was 50 basis points rather than 25. And then after they had 3 rate cuts, the Fed paused after the third rate cut, right? So you had 3 rate cuts, and then the Fed paused. And it seems like this time we're getting 3 rate cuts. The first one was 50, but then the second was 25, and then the third one also 25. But it seems like you're getting sort of those 3 cuts at 3 meetings in a row. And then at the 4th meeting, which will be in January, the market is speculating that it will be a pause, which is kind of what happened in 2019. You had 3 rate cuts, and then at the 4th meeting, the Fed paused. So in terms of monetary policy, you can see, a lot of similarities in how it's playing out. And remember, we talked about this as well throughout a lot of 2024 with Bitcoin, is that it would likely play out kind of how it did in 2019, where it would spend about 6 months putting in lower highs as those rate cuts came in, right? You see that? You see, as these rate cuts came in, you got Bitcoin putting in lower highs for about 6 months, and then it broke out. Same thing here, right? As those rate cuts came in, you had Bitcoin putting in lower highs for about 6 months, and then it broke out. Yes, we did get a pandemic-induced recession that led us to a hard landing, but that's one of those things that's very hard to predict. What was easier to predict was just sort of the lower high structure by Bitcoin throughout 2024, throughout sort of the summer, that from March until sort of September, October. That was a lot easier to predict because it's essentially exactly what happened last cycle when the Fed cut rates. And then after about 30 weeks, right, after about 30 weeks in 2019, Bitcoin broke out. And the same thing happened this cycle, right? After about 30 weeks, Bitcoin broke out. Well, look at that. 30 weeks later, and then here is basically 30 weeks later when Bitcoin broke out, right, from the lower high structure. So there continue to be a lot of similarities between what happened back then and then of course sort of the argument is that as long as the unemployment rate doesn't continue to go up too quickly, and as long as the inflation rate doesn't continue to go up too quickly, then Bitcoin continues to climb the wall of worry. Um, until you see a concerning data point by either of those metrics, the most likely outcome, right, is that Bitcoin climbs the wall of worry. What's really interesting about Bitcoin is that despite all this macro stuff, it's basically just following what it did in 2023. The orange line is year-to-date ROI of Bitcoin in 2024. The blue line is year-to-date ROI of Bitcoin in 2023 at this point. And you can see that it looks almost identical. You know, they look almost identical to each other. And that's why I say, right, I mean, you know, the best strategy for navigating not just Bitcoin, but investing in general is just a DCA strategy based on risk levels, which is what I use, but you can use basically anything. Because despite all the macro noise and whatnot, Bitcoin is just doing exactly what it did in 2023. We'll obviously see what happens in 2025, which is only a few weeks away, but it is interesting how similar, you know, 2024 is to 2023. And again, as I've pointed out before, it's not just Bitcoin. It's plenty of different markets. And if you look at, say, sort of the blue chips within each asset class, the ones that have been performing, you know, among the best, if you look at NVIDIA in 2024, it's basically tracking what it did in 2023. So it really is fascinating how similar these things have been in 2024 compared to 2023. Obviously, it'd be a good thing if the unemployment rate does not continue to go up too quickly. I know we never did. I guess we never did the labor market video after the release. Maybe I'll still do one, but there just wasn't not a whole lot changed, right? I mean, the unemployment rate did move up a little bit, but it's still below the prior cycle high of 4.3%. So, anyways, guys, we will go ahead and wrap it up there. We'll see if Bitcoin, what it does here. We talked a lot about, you know, is it following 2016? Is it following 2012? Is it following 2020? Obviously, if you look at it compared to 2020, sort of late November, early December, this is basically exactly what Bitcoin was doing back then, right? Where it was just hesitating for a few weeks. If you look at 2016, Bitcoin did continue to go up into the end of the year, but the counterpoint is that, sorry, this is NVIDIA. The counterpoint is that in 2016, you know, Bitcoin's already exceeded, or basically, yeah, it's already exceeded sort of the 2016 returns in 2024. And in fact, if you look at 2023, Bitcoin, you know, it sort of elevated around this time, but then it essentially stayed flat. The counterpoint, though, is if you compare this to the average of prior halving years, right? If you compare it to the average prior halving years, Bitcoin's basically where it has always been around this point in halving years on average, right? The average return of Bitcoin in 2024 at, you know, today is 2.28x. So that's the return of Bitcoin in 2024 at this point is 2.28x. The average return of all prior halving years at this point was 2.3x. If it continues to follow through to the end of the year, that would put Bitcoin's year-to-date ROI closer to 3x. So that could put it as high as 120. But if it just follows, 2023 and just kind of remains flat for the rest of the year, then you might have to wait until 2025 to see something like that. But anyways, guys, we'll wrap it up there. Thank you guys for tuning in. Make sure you subscribe, give the video a thumbs up, and again, check out the sale on Into the Cryptoverse Premium at intothecryptoverse.com. I'll see you guys next time. Bye.